Hey everyone, welcome back to Corporate Decoder, where we unpack the confusing language of corporate filings to find the real story. And today we've got an amended report from Nexalin Technology Incorporated that has got some interesting twists and turns. This filing is an amendment to Nexalin's annual report for the year ended the 31st of December 2024. Think of it as a do-over, not for the whole report, but for a few specific parts they re-cleaning up some wording in their internal control report and adding a missing piece to their CEO and CFO certifications. Because those certifications are being refiled, the financial statements from that annual report also need to be refiled. It is not a rehash of the entire year, but rather a correction of a few administrative details to ensure everything is accurate and compliant. Let's dive straight into the meat of it, the financial statements. These are the numbers that tell the real story of what has been happening at Nexalin Technology Incorporated. First up, we have the auditor's report from Markham LLP. They've given their opinion that the financial statements present a fair picture. However, they've also included a pretty crucial note here about going concern. This is a big red flag. It means the auditors have serious doubts about whether the company can continue to operate for at least the next year. They point to significant losses and the need for more money as the reasons. This is the kind of thing that makes investors sit up and pay very close attention. Now, let's look at the balance sheets. This gives us a snapshot of the company's assets, liabilities, and equity at two key points in time. For current assets, their cash and cash equivalents are fairly stable, sitting at about $574,000 at the end of 2024 compared to $580,000 at the end of 2023. Not a huge change there. Their short-term investment saw a nice jump from just over $2.3 million to nearly $3 million. That is a growth of about 23%, which is a positive move, indicating they might be putting their available cash to work. Accounts receivable, money owed to them, is quite low, only about $13,000 in 2024, down from $9,000 in 2023, which is a good sign, meaning they are largely collecting what is owed to them. Overall, total assets grew from about $3.6 million to just over $4.2 million. On the liabilities side, accounts payable. What they owe to others remained pretty steady around $155,000. Total liabilities are low, around $546,000 for 2024, which is a good sign for financial health. Now for stockholders' equity, this is where we see a significant increase in shares issued and outstanding. They went from about 7.4 million shares to over 13.3 million. That is a massive increase of over 79%, primarily due to issuing new stock. This directly reflects in their additional paid in capital, which surged from $80.2 million to a whopping $88.3 million. This indicates a substantial amount of new capital was raised, likely from selling stock. However, despite raising all this capital, their accumulated deficit, the total losses over time, also grew substantially from $77 million to $84.6 million. This means that even with new money coming in, the company is still operating at a significant loss. Let's shift to the income statement, which shows how the company performed over the year. Revenues increased from about $110,000 in 2023 to $168,000 in 2024. That is about a 52% increase, which is good to see. But the numbers are still very small when you consider the scale of operations implied by the stock issuance. Cost of revenues also went up, but not as much as revenue, which pushed their gross profit up from $85,000 to $132,000. But here is the catch. Their operating expenses are where things get really concerning. They jumped from $5.78 million in 2023 to a massive $7.88 million in 2024. This 36% increase in expenses is significantly outpacing revenue growth. The result is a much larger operating loss. They went from losing $5.7 million in 2023 to almost $7.8 million in 2024. That is a 35% increase in their operating losses. And when you factor in other income and expenses, their net loss for 2024 was $7.6 million, a substantial increase from the $4.6 million loss in 2023. This 64% increase in net loss is a critical indicator of the company's financial performance. You can also see the impact of all those new shares on a per share basis. The weighted average shares outstanding jumped from 7.3 million to 9.2 million. This dilution means that each existing share represents a smaller piece of the company. Looking at the statement of changes in stockholders' equity really clarifies where all those new shares came from. You can see that in 2024 they issued 3 million shares for cash, bringing in $4.5 million. They also issued a large number of shares, nearly 2.9 million, for stock compensation and another significant chunk for services. This massive issuance of shares is definitely how they are funding operations and growth initiatives. Total stockholders, equity increased to $3.67 million, but remember this is largely due to the capital raised, not necessarily from profitable operations. The cash flow statement tells us how cash actually moved in and out of the company. As expected, their operating activities used a lot of cash. They used nearly $4 million in 2024, which is slightly more than the $3.8 million they used in 2023. This consistent drain on cash from core operations is a major concern, especially without a clear path to positive cash flow. Their investing activities show they sold over $33 million in short-term investments while purchasing almost the same amount. This suggests active management of their investment portfolio to generate liquidity. And critically, their financing activities show $4.5 million coming in from the sale of common stock for cash. This cash infusion is what is keeping the lights on and funding those operating losses. Let us touch on the business itself. Nexalin Technology is focused on developing neurostimulation products, aiming to treat mental health issues like anxiety, insomnia, and depression without drugs. Their Generation 1 device is a CES device, and they're reworking on newer generations, Gen -2 and Gen -3, with advanced waveforms. They've been public since September 2022, trading under the ticker symbol NXL. They're also an emerging growth company, which allows them some flexibility in reporting. Now, about staying listed on NASDAQ. This is a crucial area for any public company. NASDAQ has rules, like maintaining a minimum bid price of $1. Nexalin has had some struggles here, receiving notices about not meeting the minimum bid price. While they've managed to regain compliance at times, it is a constant battle that shows the market S perception of the company, S value. They received a notice in September 2024 that they were not in compliance, but then regained it by October 2024. This back and forth indicates volatility. They also need to maintain at least $2.5 million in stockholders. Equity, they briefly dipped below this in early 2024, but then managed to get back into compliance after issuing more stock. Again, the need to tap into equity markets to meet listing requirements points to reliance on external funding rather than organic profit generation. This note really elaborates on that going concern issue. They have a massive accumulated deficit of $84.6 million and are still burning through cash with significant operating losses. They admit they will not have enough cash to meet their anticipated needs for the next 12 months without raising more capital. This is a direct statement from the company acknowledging their precarious financial situation. They have a few revenue streams, including licensing fees, equipment sales, and royalties from manufacturers. Their device sales, which is likely their primary product, brought in $55,000 in 2024, up from nothing in 2023, while licensing fees and equipment sales make up the rest. Looking at revenue by geography, US sales were about $83,000, and China sales were $85,000. The growth in China sales from $3,600 to $85,000 is a significant jump likely tied to their joint venture there. This section covers any legal issues or significant commitments. There is a lawsuit from a former employee claiming unpaid wages and sexual harassment. The company intends to fight it vigorously, but a trial is set for June 2025 and the outcome is uncertain. This is a potential financial risk. They were also in settlement talks with California as Employment Development Department over worker classification, which initially involved around $300,000, but their liability has been reduced and is now around $40,000. This note highlights customer concentration. In 2024, 2 customers made up 58% of their revenue. That is a lot of eggs in a few baskets, which can be risky if those customers leave. And even more concentrated on the accounts receivable side, where 3 customers accounted for a staggering 88% of what they are owed. This heavy reliance on a few customers, especially one identified as a related party, is a significant risk factor. They have significant net operating loss carryforwards of about $23.8 million. This means they can use these losses to offset future taxable income. However, they had to put a full valuation allowance against these deferred tax assets because it is not likely they'll be able to realize them. This is standard for companies with a history of losses. Finally, the company views itself as a single operating segment focused on neurostimulation products. The CEO, as the chief operating decision maker, reviews performance on a consolidated basis, so there aren't separate segment financials to dissect. So what is the big picture here with Nexalin Technology Incorporated? On one hand, they are actively pursuing their business goals, developing new products in the mental health space, and successfully raising significant capital through stock issuances. They've also shown revenue growth and managed to stay listed on Nasdaq despite some initial challenges. The expansion into China through their joint venture also looks promising on paper. However, the major story here is the persistent and growing losses. The company is burning through cash at a high rate, and to meet their obligations and continue operations, they rely heavily on issuing more stock. This dilution, coupled with the going concern warning from their auditors, paints a picture of a company that is still very much in the startup phase, heavily dependent on external funding rather than generating profits from its business operations. While the technology might be promising, the financial reality is that they are not yet self-sustaining. The concentration of revenue and accounts receivable with a few customers, including a related party, is another significant risk that investors should watch closely. It is a classic story of a growth stage company in a developing market, and whether they can translate their technological advancements into sustainable profitability remains the key question. Alright, that is our breakdown of Nexalin Technology Incorporated's latest amended filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives. And don't forget to check out our Discord server, linked in the description below for more community discussion. Thanks for watching, see you next time.